Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and this is The Mortgage Voice, and we are available on demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. Hey, we upload the show every week, and every week you can go there and find it. We shoot it for video, and we have audio. Just search for The Mortgage Voice, and you can also listen to the show on demand on your mobile device via any of our podcast partners, Apple, Google, Spreaker, iClips, Spotify, Stitcher, and more. Plus, we are still available on traditional radio. That's right, I love some radio in a number of different markets, including those in the Inland Empire, California, Las Vegas, Albuquerque, New Mexico, and Lake Tahoe. So tune in. And again, I'm Jeff Barton. This is The Mortgage Voice, and thank you for listening. Okay, so it's been a busy week, and we got three topics to get to before we get to some terrific guests as we bring to the show each and every week. We can tell you a little bit about what's happening in the mortgage rates, and I think that's always a way to go. I think the main thing about everything that we do on the Mortgage Voice and really what people look for in buying and selling real estate, price, cost. That's all really that's important to most people, consumers. However, there's so much behind all that and how we arrive at that, and that's what I want to get to today. Okay, news to use section, let's get right to it. Their interest rates today, 30-year fixed, 3.24, 15 years at 2.62, 2.86 is the jumbo. No, that's not the jumbo, that's the FHA loan. 3.15 is the jumbo, and that jumbo rate, as I say, has gone up about 10 basis points in the last 10 days. 3.37 for the 5/1 ARM. The 10-year is at 1.59. The 10-year, as everyone knows, is the indicator. Now the taper has started and will continue until it's finished when the Fed is not buying any more mortgage-backed securities or any more treasuries. That'll end it next June. But the 10-year will become more and more of a point by which you can look at. If that 10-year yield on the 10-year goes up, you can bet your boopy that the interest rate's also going to go up. That's really what you look towards when you're looking at different indicators. There's a number of other ones, but that's certainly the main one, and that's what we in the industry look towards. And so when we're looking at whether the bond market is strong, whether it's weak, that indicates whether that particular yield is going up and down. So check that out. Okay, the refi apps down 31% year over year. Down 31% year over year. Think about that for a second. That means that next year probably going to be down another 31%, which means that obviously the mortgage market is changing, and that is that's not good news. What does that mean? That means the rates are going up. Okay, so we've got a lot of people predicting 4% rates by the end of next year. Well, that's not too far from where we are, but it's certainly 25% above where we are. And as prognostications go, I wouldn't go as far as that. I would say probably, let's see what's happening in February. If we see February rates starting to loosen up again, then 4% is probably true. However, if inflation kicks in and that is somehow a catalyst in an election year to push rates higher, yeah, that's a problem. And I want to get to that, as well as who's going to be the Fed chair anyway. We just don't know yet. We're probably going to get an announcement from the Biden administration before Thanksgiving. There's a couple people in the running, and as I said, we'll talk about that some. FHA premiums up or down. Okay, so they have been collecting this, that they collected what they called the adverse, action fee? No, not adverse action. Anyway, it was a fee of 0.5 point on refinances for about 10 months. Well, they've stopped that. But Fannie Mae, Freddie Mac, FHA, they've all got a lot of money since the mortgage insurance premium that FHA collects or this adverse fee that they were collecting for 10 months. So is it now the time FHA should lower their monthly premium or their yearly premium or their upfront funding fee or their upfront costs? I say, yes, why not? I mean, I think the reserves are there. That was one of the reasons that they went the way they went, and I don't think we have much of a reason to fret on the FHA deals any more now than we did 2 years ago. So my answer is yes. Okay. Home equity loans. That's a good point. Where are we with that is, you got a lot of equity in your home, and you don't want to lose that terrific rate you have. So what you want to do is probably go out there and find either a second or a home equity line of credit. Home equity line of credit is obviously something that you can use your home for as much as you're qualified for, or for whatever it is that you want. A lot of people use the home equity line of credit to pay off high credit balances that they have on their credit cards, or to be able to at least have access to money if and when they need it, either for an investment, either for medical. There's all kinds of reasons you need money readily available. And at a blended rate, that would be what you would qualify for, i.e. the low rate that you have on your 30-year, or maybe you own your house outright, and whatever the seconds are going for. Now, the seconds traditionally don't really cost all that much. You're not borrowing the total, but you are borrowing, obviously, against the house. And with the equity most people have in it, that shouldn't be a problem. One more thing, At Properties Company buying Christie's International Real Estate. Interesting. It's out of Chicago, At Properties, and they have decided to jump, right into the real estate market by buying Christie's. Now, Christie's isn't really a huge name in the real estate business, but it does have a cachet, a panache, a certain brand name that really resonates across all markets, especially in the U.S., because Christie's Auction House, Christie's Properties, what they do in terms of the high-end market, it is something. And we'll see what happens with that and how they do that. All right. So we got a few minutes left. Yeah, we have about 3 minutes left. First thing I want to talk about, this is, we talked some about Jerome Powell. He is the head of the Fed, and he may or may not be renominated to run the Fed, but there is another candidate out there, and Lael Brainerd, that's her name. She's kind of the vice chair of the Fed. She's the head of, the Fed, 9 board governors, right, and they're spread across. And by the way, if you want to look into it, it's kind of fascinating how the Fed works and what it is that determines policy. Policy meaning, do we make money cheaper? Do we make it more expensive? Do we, as they have been doing in what they call an accommodation, buying mortgage-backed securities and treasuries? Do they affect rates by charging member banks more than what they are currently charging it, 0 to 0.25% on the overnight rate? Or the Fed funds rate. All of these things are important, and the background to both of these candidates is also important. There is a terrific article in Yahoo about Lael Brainerd, and she is she's very well educated, Harvard for her grad degree. She also taught at MIT and at the Sloan School. Let's see, what else? She is an economist by nature. Not by nature, but by training. So what we have is Jerome Powell is a lawyer by training, and so you have the different aspects of what both of these people bring to the table. Obviously, Jerome Powell's been in the job. Experience counts. He's 70% of the way in terms of what the betting odds are to get the renomination, but Lael Brainerd is a very, very good choice as well. She has some background in both regulatory as well as policy, and her views on how we should be addressing what comes next, i.e. should we listen to the hawks who are saying no, inflation is the most important thing, or the new accommodation, which is really we're looking for job growth prior to clamping down on inflation. Interesting part of that, right, is inflation as bad as people say it is, or can we afford inflation? This has come up a number of times. Now, politically, you can't talk about this stuff, so I have no political bias one way or the other. However, there is if you go for inflation being important, you are saying that job creation and wage, people making more money, is not your priority. What you're really worried about is the average person on the street spending $4.50 a gallon of gas rather than $3.50. Granted, that is a consideration, and obviously one that is really split the country, right? We're not quite sure what it is and how to get there. However, wage inflation is really the number one thing driving inflation overall. I talked to a guy today about it at length. For a long time, I had an explanation for it. But really, it's wage growth, the product growth, the way people are in demand of certain things today, driving prices up, lack thereof because it's sitting on ships. However you look at it, if we're going to pay a guy more money today than we paid him yesterday, we got to recoup that. And so how are we going to do it? We got to raise our prices. That's called wage inflation. That's probably not going away. Anyway, I'm Jeff Barton. We'll get to this more in the next section, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. Hey, check out our website, themortgagevoice.com. There you can find our latest on-demand episodes of The Mortgage Voice and information about our guests, as well as their contact information. You can also read my blog, which keeps you up to date with the very latest mortgage news. Check it out. Hey, bookmark us. That's themortgagevoice.com. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Each and every week we bring to the show somebody, actually a number of different people, about 3-4 different interviews for the hour. In the lending industry, I bring experts only, and this guy has been on the show once before. Really appreciate his expertise. He's going to tell us about his company. It's Christian Ramos from West Gen Lending. Christian, how you doing? We've lost Christian, so we'll have to try to get him back. Anyway, what we want to do is try to get from him the difference in programs, what kind of programs there are. Now, there are a number of different programs that you can get, 30-year fixed, 15. As we go over the rates each and every week, whether it's an FHA product, you can certainly get a jumbo loan, a number of different ones. And as a result of that, bringing people on the show to talk about the programs at their particular lenders. If you use a mortgage broker, which many, many people do, I suggest using a mortgage broker. They can shop to get you the best program or the individual program at many, many different lenders. And that's one of the things that I think is incredibly important when you're out there shopping for a loan. Making sure that you get the best price, making sure you get the best program, making sure you get choice. If you go to one lender or a major lender, and I don't care who the lender is, it's not always that way. However, how we doing, Daryl?
I get a voicemail. I'm trying back.
Oh, okay, very good. Okay, so if we get him back, we can dive into that. Programs is not my forte nor my specialty. However, I do enjoy speaking with the experts in the field who do that sort of work. And again, we have many, many people. We have correspondent lender people who look to small lenders like Malibu Funding, the company that I work for that works for the show. Their NMLS is 79620. And WestGen, which is Christian's job as the account executive there. However, inflation, we talked about it. We talked about Lael Branard. We gave some interesting ideas about what inflation is and how it affects you each and every day. And that's also important. One of the other things I wanted to talk about, here he is, Christian.
Right on time.
Yeah,
How are
I
you?
am here. Not sure what happened.
He's not there.
But we are back.
I don't know. Are you there?
Yes, I'm here. Can you hear me?
I don't know.
Yeah, I'm able to hear you. Hello?
Oh, there you are. Hi, how are you?
Yeah, even previously I was able to hear you, but for some reason I'm not sure what happened. Yeah, you weren't able to hear me.
Excellent. Well, that'll be interesting radio, won't it? Okay, so let's talk about WestGen and what you guys are doing for programs, how you're helping solve some of the issues for borrowers out there.
Yeah, pretty much everything under the sun nowadays. Everybody's starting to open up with the non-QM products. You're starting to see it. You used to have your non-QM lenders. Now, pretty much everybody's offering some type of non-QM. So I used to come in with my FHA, VOE only, and some type of products that, not everybody out there has. But now I'm having to keep up with everybody because, non-QM and everything's on the rise with a lot of investors really taking, advantage of the market and really trying to open up the boxes out in the lending world.
Yeah, I read an article today that talked about private placement of these securities through whatever securitization they do, and they said that 22 is going to be a lot harder than 21, yet what you're saying is absolutely true. This non-QM market is huge. What's going to happen, and how are we going to make sure that obviously it remains liquid? And how do you do it at WestGen? Do you have credit lines? Are you owned by a REIT? How does it work over there?
Yes, it's all direct, but for the most part, portfolioing the loans is something that we're starting to do more with the non-QM end of it.
Okay.
Most of it, we're selling the service of FHA, VA, or any conventional stuff. But right now, the non-QM is really leading the way. A lot of bank statement programs,
Okay.
a lot of debt service credit ratio, where investment purchases are really just flipping very quick because of the market having the demand of flipping these loans very quick. So, that's starting to open up the portfolio pool that we have. It is starting to grow by the month.
Do you see that? Okay, let's talk rates a little bit. Obviously, conventional rates have gone up a little bit. How does the way conventional is priced affect non-QM pricing?
Yeah, well, the market obviously is what's driving the interest rates. Year ago, it was so artificial, but now you really see the 10-year bond market affecting where the rates go. Investors are obviously doing their risk adjustments and what they do in terms of when they're selling these loans in their buckets. But everything in terms of the interest rates, still, as you've seen, the topic's been are the interest rates going to go up? When are the values going to drop? But they've been maintaining, and I'm doing, for instance, types of loans in the low to mid fours for bank statement 10% down types of loans where there's no mortgage insurance. So you're starting to really compete with, your not so much your FHA, which has still record low rates, but conventional, which you do see them creeping up with a 10-year bond, as well creeping up.
Yeah, I don't see the competition for rates as an impediment to a borrower wanting to. I mean, if you're talking about the difference between 3.25% and 4.25%, but yet on a non-QM product, it's a lot more flexible in terms of what you can get. I think that's a very fair competitive advantage that you might have.
In this type of market, that's a fair statement.
Do you see more purchase coming online? How are you with the purchase versus refinance?
Yeah, it's kind of the building and the mortgage for purchases go hand in hand. It's just the demand trying to keep up with everything. Everybody's trying to come in and compete even with cash offers, and that's the type of market that we're dealing with nowadays. The purchase is still there, but the drive in cash out and refinance, the wave, has pretty been much 50-50, and we know that market isn't here to stay, but I got to answer your question by, the purchase market is still thriving.
Right. Okay. So you mentioned the cash out. Obviously, that's going to be the focus of of lenders when refi dries up, because the amount of people available to do a refi because the rates are going up diminishes. It's going to be hitting hard on the cash out refi. Are you going to see a growth over at WestGen to seconds or some kind of a HELOC?
Well, I see it on the horizon with other lenders because of the fact that I have my competition. Sometimes, brokers are telling me, hey, I'm having, 80-15s. And so I'm hoping it's around the corner for something we have to offer. But as of right now, especially with the non-QM, there is no mortgage insurance. It's mostly just on the FHA, obviously, and conventional. But, the need for it, I do see it because of the fact now the values are going up. A lot of the Riverside, San Bernardino areas where there are no high balance are getting away with those higher purchase amounts with 80-15s and breaking up with the, closed-in seconds. So I do see that, but these, loan amounts are right around the corner going to be increasing, so that's going to bring some relief as well.
Yeah, do you have any idea what the increases are going to be? I mean, is it...
Hasn't been announced officially. FHA should be hopefully this month. A lot of people are anticipating $625,000.
Right.
Some lenders have been kind of just doing some type of percentage that they feel comfortable with, and will be, not selling loans until next year once, all the announcements and everything are official. But as of right now, I don't have anything, concrete, which everybody's kind of keeping their ear to the ground.
Yeah, no, I agree with you. Also, Technology versus manual underwriting. How do you guys handle it over there in the non-QM space?
And that's really where, you set apart the banks that know how to handle the non-QM and these types of lenders that more vanilla, and it's tougher for them to digest these types of loans. And
right.
Yeah, that's where we have a team of non-QM jumbo types of underwriters that don't always have to look at the loan. It's not so much creative underwriting, but it's real creative. In terms of everything that you do with underwriting, it's all what you look at the loan in terms of the guidelines for the investors in terms of the loans that go through non-QM. Everybody just kind of thinks that it has to fit a particular box, and it's true because some lenders interpret the guidelines different, and they kind of mix it and marry it with the way they underwrite FHA and VA.
Right.
But no, it's totally different, and that's where we have our own team of underwriters that have been always doing to non-QM, and I think that's where we kind of step ahead with the lenders that are really pulling out non-QM at a record pace, because you really didn't see the type of lenders offering non-QM that are offering it as of this type of market.
Now, do you find that assessing risk in the non-QM space is different program to program or lender to lender, or is it just about the investor and what they're willing to purchase?
At the end of the day, the pool the investor takeout for these types of loans, it's the buckets that they fall in, and yeah, there are the types of lenders that are going lower FICOs. There's some bank statement programs that even go below 620, and I think that's where you're finding the risk factors that these investors are looking at.
Right.
We keep it at 620, which is a little bit lower than other lenders with bank statement programs, but I think at the same time you're looking at loans that perform, and we've been doing the non-QM for about 6 months. Other lenders have also just kind of getting used to the product, but I think for the most part it's all about the performance of the loans, and everything right now in this type of market, the investors are willing to take that risk, and they are performing.
Right. Okay. Hey, Christian, could you shout out your phone number or a way by which people can contact you with questions about WestGen and some of the programs you talked about today?
I appreciate that.
Sure.
Yeah, you can always contact me directly, and any questions on scenarios or pricing at 626-407-7101. And again, that's 626-407-7101.
Excellent. That's Christian Ramos from WestGen Lending. I'm Jeff Barton, your voice in the mortgage industry. Christian, thanks for coming on. I really appreciate it.
Thank you for your guys' time.
Okay, excellent. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, for listening each and every week. We're on a number of different podcasts. We're on YouTube. If you go to YouTube, you can see us, hear us. You certainly can get all the terrific guests we have on the show if you go to our website, themortgagevoice.com. We're on, as I said, 5 radio stations, 3 different states, or is it 3 radio stations in 5 states? It's one of those. And we're really happy to bring the information about mortgages, real estate, and the experts that come on the show to be able to deliver that to you. I'm happy that they do it, and we've been doing it now for hundreds and hundreds of shows, 8 years, 9 years, something like that. And today is no exception. We bring back to the show Dr. Jeannie Bertelli. She's on the phone from Florida. Jeannie, how are you?
I'm doing great, thanks, Jeff. How are you?
I'm fine, thank you, and thank you for asking, too. I wanted to bring you on the show because we haven't had some hand-holding, which I think the country needs as a group, to be able to continue to try to be vigilant, at the same time not kill each other over silliness, which I think a lot of this stuff is. And I try to counsel people to say, stop watching, stop listening. But what do you see in terms of not only in real estate itself, but in the market or in the country overall, as to the mood and what we can do to sort of calm down a little bit to try to get us through not only the holidays, but some more of the COVID that is definitely going to kick up once again?
Well, first, I think I want to start with what's most important, which is how we're all doing and that we're all in this together. I have seen a lot, as I'm sure everyone has, about enemies and opposition and hatred and just this heightened emotionality almost over any issue, certainly about politics, but it can be about vaccines, it can be about just anything. And for me and for the people I'm around and the people I counsel, I, very much like you, I really encourage people to stop talking about these matters and to remember we are each other's neighbors, we're each other's community, and we are in this together. And none of that stuff, it really isn't what we should focus on, and it's not what really matters in our lives. And to let's come back with an open heart to each other. And it's crazy and trite as it may sound, to love each other again.
No, it's great advice. One of the reasons I wanted you back on, in what we do on the Mortgage Voice, because we're volatile, because we follow a number of different things that cause not only the show, but interest rates to go up and down and people's expecting something or not expecting something. We, too, need to do that, and having you back on really helps. I see that there are reasons why people continue to listen and engage in these things that drive them crazy. It's whatever is released in the brain to give them a high. What do you say to combat that and to try to, get something similar but not that way?
Well, one of the things I ask people is this making you happy?
Right.
And inevitably it isn't.
Right.
It is these larger corporations that are trying to extract from us heightened emotionality, and it doesn't actually serve us, it serves them.
Right.
So when people are in that heightened state, and if they're open to hearing it, that's the other thing, is I generally start with, are you open to hearing anything? Because people who are really down the rabbit hole aren't interested in hearing anything else.
Nope.
And those people, I can just wish well and try to stay off the topics. But I still don't want to turn my back on any person or any community, because I just think we're all in this together, and we need to remember that. We have the power to turn those things off and to turn toward each other and love each other again.
No, I think that's great advice and absolutely the truth. I know that you also dabble in real estate, not dabble, but it's probably one of your main focuses in life in terms of, buying and selling properties. You're in the that business, buy and hold, buy and sell, however it is that you do your business for real estate. It can be a crazy making thing in and of itself, let alone you add the rest of this involved. And then I'm in a situation whereby people are losing their minds because a loan is a couple of days late, and I'm like, no, you just let it happen. It's going to happen. We're all in the business to make money. But I think all of this adds to issues, whether it be at work, at home, in schools. I mean, it's time to take a deep breath.
It is time to take a deep breath. And yes, things have changed. I'll just briefly tell you about the real estate market here in Florida.
Please.
Because a lot of people have moved from New York and California and driven up prices here.
Yep.
So last year, more than anything, prices were going well over asking price, as it was in many places in the country, but they just drove our prices up so significantly. I personally sold 2 small condos in St. Louis, downtown, and then I bought one down the street here that used to be my aunt's here in St. Petersburg. So I got to not get in the bidding war because I bought it off of a relative.
Right.
Not necessarily a discount, but at a fair price.
Right, and you don't have to make yourself nuts with the negotiation and the waiting and the wondering and the hoping. No.
Exactly.
Right.
Exactly. And so actually one of the things I want to tell people who are maybe in a position like I am, where I don't have all this money and can't just pay cash for this and that, my way to stay in the market and to continue to invest and to continue to expand my real estate portfolio is I always look for somebody who will hold the mortgage for me. And several times in my trajectory, I've had owners hold mortgages for me and paid them a very fair, above market interest rate, so that we're creating the win-win. And so I'd encourage others to do that and ask for that.
Seller financing, yeah, I think if we get to a point where prices are out of control and rates rise more rapidly than they have been, seller financing will make a huge comeback. I don't think it's used often enough now because, as you said, a lot of people with cash out there ready to go. But some people want a income rather than a lump sum. It's just better for them for whatever reason. And asking is a great way to see if that's possible.
Yes.
Where else are you looking for investment? I have several ideas, and I have a guy who is buying units up in Maryland from here in California. And I guess for you to look and seek out those kind of investment opportunities without making yourself both crazy and eating up all your time, how do you do that? Or is it just a hit or miss proposition?
I tend to go with where I'm living or where I'm going to live. So at this point in my life, I think I will have two mainstays, one here in St. Petersburg, Florida, and the other one somewhere up in New England, perhaps Maine. And so that will be the next place I look to invest, is where I will live in the summer. And I do think, being able to be there on site, not have to travel to it and have no ties to it. For somebody who's as unanchored as I am, it helps to have some place where I will go back and forth and not a place where I don't have ties.
Yeah, that's interesting. I think that there are a lot of people, at least who've had kids, who are now kind of on their own, kids are gone, who have investment dollars and are looking for something to, put their money into. You're saying for yourself, it's a place that you're going to spend some time. It's not just an investment like this other guy was up in Maryland, where he has no need or want to go live there, but having the ability to do that really, it sets you up to be able to be on site for any repairs, any renovations, all that.
Right. And even if you wind up getting one place that you kind of half share the way you're describing it, and then buy another place that's purely an investment, so that it's the location is a spot that you want to spend time.
No, I think that's a great way to do it, because you're not only, it's not just a money thing. It's also, I like this place. So you tend to really search out or seek out something that is more than just a dollar flip. I think that's a great way to go about buying. Right? I think it is. Hey, listen, people probably want to get in touch with you. You've got, obviously, on two fronts, helping all kinds of people who are in our business, whether it be the expertise in flipping or being Dr. Bertelli, being able to help them wend their way through whatever, morass they're currently in. Could you give us an idea how to get in touch with you?
Absolutely. You can always email me at Dr. Bertoli, DrBertoli, @gmail.com. You can reach out for me at my website, which is drbertoli.com, or you can call me at 727-262-4271. I'll be glad to help you out.
Thank you very much, Dr. Bertoli. Great to have you on again, and great catching up. Thanks for coming.
Thanks, Jeff.
Thank you.
Have a great holiday season.
Okay, you too, Jeannie. Thank you. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Check out the website, mortgagevoice.com. You can find our latest on-demand episodes of The Mortgage Voice, information about our guests, as well as their contact information. That's really important. If you hear something you like, you want to get in touch with them, themortgagevoice.com. That's the way to go. You can read the blog there. It keeps you updated with the very latest mortgage news. Check it out and bookmark us, themortgagevoice.com. Jeff Barton, The Mortgage Voice. I am here. Thank you very much. Our first, last, and best guest right now, Josh Thompson, who is a developer, real estate agent, broker in Southern California, but really works all over. I wanted him back on the show because he's talking about commercial and what's going on all over the U.S. in terms of opportunity. Josh, how are you?
I'm doing great, Jeff. How are you?
I'm fine, thank you. Let's get right into it. You were telling me off air that you're starting to, you put shovels in the ground in Inglewood. How is that going?
Oh, man, it's going great. Aside from a little mishap that's going on now, so we've been working on the project for years, and we are doing 20 houses there with all subterranean garages for each home.
Right.
And we're in the shoring and excavation process now, and we discovered a 80-foot long, 10-foot thick storm drain that was not shown on any preliminary title report or survey study that we had done preliminarily. So we are trying to figure out what's going on with that. The city is saying that it is still active, even though it is connected to an abandoned storm drain on the shopping center next door. It is just a cluster, you know what, if that makes any sense. So not going to slow us down in anything. We are still building around it, but if it is, in fact, live storm drain, which I don't see how it could be if it's connected to a dead, connector under the shopping center, we are going to have to do like a 5-month MTD study to properly do tests to see how we can abandon it properly. So it never ends.
It never ends. And how deep did you go before you hit the drain?
Only a few feet deep. Only a few feet deep, actually. It was not too far down, and we're only going 7 feet below grade. So
I see.
It is very interesting. It's interesting, though, that the title company did show an easement on one of the 6 parcels that we combined. And it's mind-boggling that we cleared it with Public Works and actually have a grading and shoring permit, and this was not mentioned before. So it's an ongoing thing where I have a meeting after this call to discuss it and see how we move forward.
Okay, so opportunity being what it is and how to discover that, and then the process to get permits, and then on-site issues that come up. Okay, do you think this discourages or encourages, or is it just a cost of doing business?
No, it's definitely not a cost of doing business. I think it is discouraging because, local municipalities, I think that they don't really take into consideration all of the time and money that developers spend to do something that's actually improving their community. I mean, housing is definitely, there's definitely
needed.
A shortage of new housing, for that matter, in Los Angeles County. And, we are trying to provide this and make it better for the community. And we are dealing with issues like, discovered a lot earlier, or at least mentioned. So I do think that cities need to be a little more, responsible in terms of what they're reviewing. And I do understand Inglewood, everyone's busy, and the pandemic has seen like a heightened kind of volume in real estate transactions, no matter what sector of real estate you're in. But still, it's us actually just having to bite the bullet and take care of something that the city is not going to take care of, and there's no responsibility on their end as it seems now. So discouraging, I would say. If
you had to do the 5-month study, you're looking at finished product when, next summer?
Yeah. I mean, our contractor is saying that they have a plan to, which I don't know to be the case. I mean, we had a projected 15-month timeline of getting everything built.
Yep.
And we started last month. But they're saying that we can still meet that timeline even with this issue. If it takes 5 months, they're saying that they can build a certain row of houses first. It just, restructure the timeline of what their plan is. But I don't know. That seems ambitious to me. And I do think it will delay us a few months, to say the least.
Okay, so as a developer, explain a little bit about the process to find other projects and then to get them under contract and begin the process of development. I know that you're looking at a couple others, maybe even in contract. Give us an overview of what that's like.
Well, yeah, it first starts off with just identifying a market, and I think identifying a market that is up and coming, and I like to identify certain catalysts that are bringing economic growth to a certain city or area. And because that's kind of, the thing that helped with Inglewood. It's
Yep.
knowing all of the new developments in the Rams Stadium coming about, even with lost time that we got from, after purchasing the property and being delayed in the permitting process, we still had an appreciation going on there to where we're not really, it's making up for the loss of, money that we spent and time, because originally when we were doing this, the sales prices for each home were projected to be around $850,000. And now we just got an appraisal done when we secured the construction financing, and it's looking like each home can sell for about $980,000 on the market today. So
that's a big deal. That's a big change.
Yeah.
Jeez, good for you. Yeah.
So that's something to look for. But once you kind of identify the market, then you kind of start scouting different properties. You can use the MLS if you wish, but it's really good to even kind of target, vacant or properties that are really run down, because those are the kind of properties that you can definitely make a deal with the owner on. I even use I know for the City of LA, they have a thing called the REAP list, which is the Rent Escrow Account Program. And that's, a lot of landlords that are basically slumlords, for lack of a better word, and they're not doing adequate repairs on the property, so therefore they're not receiving rent from their tenants. So a lot of those sellers are apt to make a deal with you. And then once you kind of locate an actual property that looks nice and you want to do something on, before even engaging in making an offer or making a deal, you kind of got to have like an architect that'll at least draw up or give you an idea of what can be built on the site, so you can maximize the value, because you definitely want to be able to increase the density. And there's a new law that's kind of been put into place that I'm still getting familiarized with in California. Just what is it? The SB 9 and 10, referring to properties in high transit areas. Single-family zone properties are now able to be zoned for multifamily, but it's still up to the local municipality to see how many units can be built and all that. So.
No, it's very interesting. Development itself is much more problem-solving than it is than people realize. And I think if you have a mind to do that kind of thing, the return can be spectacular.
Oh yeah. I mean, even for an example, it's building equity is the best thing that you can do in real estate.
Right.
And development, I think, is the best way to be able to build equity when you're investing in an asset. Another project that I'm doing, I bought 2.5 acres a few months ago in Joshua Tree, California, actually. And I've done quite a few loans for people in that area, and I have a good architect in that town. And that's really a niche kind of market where there's a huge boom going on there.
Yes, there is.
So just numbers, for example, on that, I purchased a lot for $172,000, and I'm doing a 3-bedroom, 3.5-bathroom house with a pool and jacuzzi. You're going to spend maybe $500 to $550 to get it constructed, but the market value of it once it's complete will be about $1.2 million. So that's building $500,000 in equity just on a single-family house. So that's,
I'm up against the clock. This is terrific information. I want to have you back because I think a lot of people would like to get into this business. If people wanted to ask you some questions, can you let them know how they get in touch with you?
Oh, yeah. You can contact me on my cell phone. That's the best way. My number is 323-945-5694.
Excellent. Josh Thompson is a broker here in the California area, Los Angeles specifically, and obviously from the conversation, he's a developer too. So, Josh, thanks very much for coming on the show. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I am Jeff Barton, and our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. podcast form wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Inflation. How does it affect you? Will it affect you in the future? And what can we do about it? These are all things on most people's minds. Why? Because if you're watching anything on television or listening to anything on the radio, all you will hear is the negative aspects of whatever it is that you're trying to find information about. So therefore, you are predisposed to hate whatever that is. Let me tell you something. If you are a person who is now employed and you want to get more money for your job and you go and get that money, guess what that's called? That's called inflation. So while we are in an employment situation whereby a lot of people need enticing to come back to work, not because they're rich, not because they have money in the bank, mostly it's because of COVID. They're afraid of COVID. If they have to risk their lives to go to work, and a lot of people, believe it or not, still feel that way, they need to be enticed. Enticing those people back to work in whatever job and whatever job function they have requires more money. Heck, if you look at Starbucks is now at $15 an hour nationwide. Think about that for a second. There are a number of other companies. Even Amazon is paying more money, and I think they're almost up to $15 an hour. That's called inflation. It's wage inflation. It's not going away. Is it good? Yeah, if you're that employee, it's good. But if you're a person who, like a lot of us over 50, are only looking at the downside, i.e., I have to pay more in gas, I have to pay more in food. Well, the reason you do is because those companies are paying more, obviously, to their workers. And that's an issue. Now, the transitory inflation, which what we call supply side, all this means is look out in the ships, see anything in the harbor, see trucks whizzing by you. The stuff on those ships, on those trucks, trying to get to market is what's called a supply chain bottleneck, and that's caused prices to rise simply because those products that are available on the shelves that aren't being replaced, well, they're going to cost more, and that's kind of the way it is. They see that, economists see that, or a lot of economists, certainly the administration of Joe Biden thinks that way, that these are issues that will solve themselves. Now, let's talk oil for a second. You're in California, you're in New Mexico, you're up in Vegas, you're in any number of other places that this show is being heard, up in Tahoe. You drive a lot, you're in your car a lot. Yeah, I understand. The price at the pump hurts. Nobody wants to pay $5 a gallon gas. And yes, anybody who's not in California, you don't know what I'm talking about. But if you're in Texas or Indiana, Florida, Illinois, up in Massachusetts, you're paying $3.50 a gallon, and that's way more than you've been paying before, and you don't like it. You don't want to pay it anymore, and I understand that. Oil will be plentiful, and one of the reasons I know that is that that's what I read in some of the articles about the supply of oil. Now, the question of whether we divert oil from the oil reserves in the U.S. immediately to be refined into gasoline, that's another thing. Home heating oil in the Northeast, that's a big deal. And we're talking from the Mississippi to the Atlantic Ocean, obviously from Georgia to Maine. And that is a big deal. Home heating oil is really the cost, to maintain heat. So you might see those oil reserves released, but they're going to be refined into home heating oil, and that's not going to help you at the pump. Is this transitory? Yes, it is. Why? Because American shale oil is coming online. OPEC, one of the heads of OPEC, and that's the organization that the OPEC stands for Organization for Petroleum and
Oil Producing
Exporting Countries. That's what it is. And they include a lot of the Middle Eastern countries, but now Russia and some of the big oil producers in Africa and Nigeria and such, they all belong to OPEC. They said, hey, the U.S. is the leading oil producer in the world. Why are they asking us to lower our prices and produce more? Well, the reason is that we want to see immediate effect of a glut on the market so that the price per barrel drops and therefore the price per gasoline at the pump drops. That's a 6 months process. And so, yes, we're going to grin and bear it, but we will have oil. Oil is on the way. Now, let's look at, so we're talking a little bit about who's going to head up the Fed, whether it's going to be Jerome Powell or whether it's going to be Lael Brainard. And why is this important? Because these are the people that are going to determine for you whether you're going to pay more, really, mortgages and the mortgage interest rate that you have out there. And you say, why? Because up until now, at least the last year and a half, almost 2 years, with the mortgage-backed security purchase and also the Treasury purchase, the Fed has been artificially keeping mortgage rates low. So if we want to know how the Fed is going to do in the future, this is a two-horse race. We're really leaning towards Jerome Powell being approved again or nominated again by the president. However, Lael Brainard, she is one who is certainly in the mix. Quote from her, seems inflation is coming from three sources, okay? Three sources for inflation, one being COVID. Don't forget, COVID is running the world right now. So if we have supply problems, employment problems, a lot of it can be pointed to COVID, okay? Number two, where is number two? I know it's here somewhere. Okay, so the expenditures of people who used to go out to bars and restaurants, who used to go out to the movies, who used to spend time and money out doing things, are now at home buying things. And anybody who, if you've, like my household, we spent a lot of time at home during the last almost 2 years now. And that means a lot of Amazon shopping. You haven't seen Amazon have a bad quarter, have you? No. And the reason for, and by the way, they're also paying more for their employees too. But the reason for that is a lot of people are buying more stuff. And where is that stuff? You're right. It's on the ships coming to you right now from China. Yes, people got used to buying cheap stuff from China, and that's still happening. That's what happened. So not only did buying patterns change, but those buying patterns are affecting how much your stuff costs because people are buying more stuff, not doing more stuff. And that's an important distinction to make that Brainard has made. And okay, a lot of people still have cash, right? To the pandemic rescue bucks, cheap credit, appreciating home values. 3, because business underinvested in capital. Okay, this is very important. Since 2008, and I've talked about this and why housing is what it is, we have been underbuilding in housing for over a decade. We should be building 1.5 million houses a year. We're nowhere close to that. And why is that? Because the home builders themselves got burned in 2007, 2008 by rolling track after track in many different areas, whether it's Arizona, Utah, Florida, certainly in Las Vegas, certainly in California. A lot of these states where they were just building track after track after track, it got burned. Because all of those properties went under, and it took them forever to sell them off. So they are hesitant to build and continue to build. That's the other reason that we are underbuilt, and that's the other reason the capacity in the marketplace for delivering goods, for producing goods has always lacked behind what it should have been. There's a great graph, and you can look for it, and it shows where we were headed before 2008 in terms of global and domestic delivery systems on goods produced. We will see that since that time, based on what has happened versus what would have happened had we not had that recession, there is a huge gap between what should have been and what is in terms of the delivery systems and the production or producing of goods here locally. That's caused inflation because those delivery systems have not kept up. Will they really recover? Yes, I think they will. But that's one of the reasons for the temporary problem with inflation. Inflation is that three-headed monster. This is what Lael Brainard said. I totally agree with her. That's why I think she'd be an excellent choice for the Fed head. Anyway, I'm Jeff Barton. I'm your voice. This is the mortgage business, mortgage industry, and I'm the mortgage voice. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.